Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video we are looking at one of the best dividend paying companies out there, and what I'm going to do is I'm going to give you the financials. I'm going to explain what the company does. I'm going to explain the financials of this business. I'm going to give you the valuation, and then we'll compare it with the S&P 500 and also other companies within similar sector. The company we're talking about today has been in my portfolio for quite some time, I believe almost 4 years. And I'm going to tell you exactly what I will be doing moving forward, because it hasn't actually performed as well as I would have liked last year. And it's one of the companies that I'm currently looking at and saying, okay, is still, is my thesis still right? Or am I going to sell basically use that money somewhere else? So before we look at that company, I just want to talk about a couple of things. The next few weeks, so between now and the end of the month, you will see a lot more fluctuation in terms of stock market, because the earnings reports will start. So it's starting next week. We've got a few companies reporting, but the most important company that we need to keep an eye on for us anyway as investors of basically some of these companies in semiconductor companies is Taiwan Semi. This is important one. So Thursday before open, we will find out basically what Taiwan Semi says about their basically what is happening in the world of AI, in the world of everything else. So it will be interesting to see, because I genuinely think if this company goes down 10% on that day, everything else is going to go down with it. So we'll see. There are other companies, SLB, which I've actually been interested quite some time, that are also reporting, and there are other companies that will be reporting the weeks after. And the company we're going to talk about today is actually reporting, I think, on the 23rd of January. So it's another one that I need to keep an eye on, see basically how it moves, basically what it does in the next few, basically after that report. But before we do all of that, it would be absolutely wonderful if you can join us in the Patreon account, where you get access to a lot of things, all the buys and sells, the family buys and sells, the undervalued monthly dividend stocks, or basically general stocks. You got the Sharia compliant investing ebook. This book is basically something I put together a while ago, and I'm planning to update it, inshallah, if I get time between now and basically end of this month. And the reason I want to do that is because I just want to help out as many people as I possibly can. I started this whole YouTube channel thing just so I can actually reach out to as many people as I possibly can and help other brothers and sisters. We know how amazing basically the stock market is, but at the same time it can be a bit dangerous, because there are so many people telling you all sorts of things. You should buy this penny stock, you should buy this and that, and cryptos and these things. I'm not saying these things are bad, but generally you need to know what you're buying, why are you buying, and also you need to know what your goals are. I always talk about these things, and I've got a few things inshallah planned. If I get a little bit of time in the next few weeks, I will share those things with you. Sometimes what I do is, if I'm reading a book and I find something nice in that book, whatever, I just quickly jot down some ideas. I've got loads of ideas, loads of plans of videos that I haven't released yet. But inshallah, if I get a bit more time, because right now work is actually started again and it's a bit hectic. But inshallah, once it comes down, I will actually release those videos. Anyway, let's talk about this company that we want to talk about today. And that company is Union Pacific Corporation. This is probably one of the best companies when it comes to railroad companies out there. And this company has 32,695 miles of route that they cover, that they own. Okay, their business basically has almost, I think, about 4 different sectors, I can't remember, and operational metrics. Okay, including the routes that basically they cover. They have something called bulk, industrials, and premium, 3 different sections within their business. And they basically, right now, I think they've got like total employees of over 33,000 people, which is absolutely ridiculous if you think about. Now the markets, the products that they deliver are kind of categorized into 3 different main ones. So you've got bulk, which is 33% of their revenue their revenue from 2023. That includes grain and grain products, fertilizers, food and refrigerated basically products. You also have the industrial side of things, which is 36% of the revenue in 2023. That includes construction materials, industrial chemicals and plastics. It includes metals and ores, the forest, basically forest products, petroleum and liquid petroleum gases. It includes a lot of things in that, the industrial side of things. Then you've got the premium, which is basically automotive, so finished vehicles and automotive parts, so the parts that are basically used in different cars. You've got also different types of containers that for domestically that they deliver within the country, and some of them are actually international as well. And then you've got specialty commodities, which is renewables, so wind turbos, components, and so on. And then you've got hazardous materials, which include basically chemicals, crude oil materials, basically like that type of materials. So they've got so many things that they deliver. So what we now need to do is, with the fact that we actually have a little bit of idea of what the business does. Again, you can see all of these things basically written here. What we now need to do is basically where the company is financially. Okay. And as you can see, for the 1 year, so from this time last year, January, the 10th of January, whatever, in 2024, up until now, the stock's down almost 6%. Hence why we're looking at it right now to see if it's actually a buyer for us moving forward. And the first thing we're going to do is to see how this company makes money. Okay. And that is the most important, or how much it makes right now. So in 2014, the company was making $23.9 billion in terms of revenue side of it. And it has declined slightly in basically for the following 2 years. Then it bounced back again. Again, I forgot to tell you, this is very cyclical business. This is industrial, and again, it's very cyclical business. What I mean by that is, if everybody's happy buying things and things are getting delivered left and right, okay, and basically where the different types of goods, then of course this company will do well, because they have to then transport all those goods that are being bought. And if the economy is not doing well, people are not buying these things, and of course then it will hit this company. Okay. In 2020, basically they had about 19.5 billion. Then 2021, 21.8, 24.8, 24. So a slight decline. I think this one about 7% decline, basically last year's revenue. And then 2024, basically we're expecting. So by the way, the company has not reported basically the end of 2023. So they're slightly behind when it comes to reporting years and so on. I think the final quarter will be this January. So the one that is coming up very soon. And that we expect basically will be about $24.2 billion. So it kind of bounced back over the last couple of years, but almost where it was about 10 years ago. And this is probably one of the reasons why they got rid of the CEO. He's no longer part of the basic company. So we'll see what happens in the next couple of years, because you kind of CEOs cannot change things overnight. So you kind of have to give them a little bit of time. He's been there for about now a year or so, I think. So we will see. But the cost of this revenue, I thought genuinely will be a lot more higher than this. But look at it, 10.8 for that 20. So that's taken basically gross profit of $13.4 billion, which is absolutely good. This is really good, because I expected maybe this company to have a lot more overheads, but it really doesn't. And of course, after they pay taxes and all of these things, they've got $6.6 billion in terms of net income, which is very important. So the bottom line looks very healthy, from $5 billion to right now $6.6 billion, despite the drop here and there. Now, in terms of the EPS, we're looking at the earnings per share from $5.77 to right now $10.90, which is really good. So overall, there was a bit of a dip here. Basically 2017 was an outlier there, and then 2018 it dropped back again to the levels that it was slightly higher than before. And then it will be interesting to see if they made some acquisitions or something for that year, but that might not be just a organic growth and so on. So once we look at that, then the other thing we need to look at is basically the balance sheet. And this company, I do believe, has quite a bit of a debt, which we need to look at right now. So total current asset, we're looking at about $4 billion. That's not great. Okay, that's not a lot. But let's see in comparison to that current liabilities, if that covers. Okay, I'll be surprised if it actually does. Total current liabilities is $5.3 billion, which means in the next 12 months, the company will potentially struggle if they have to pay this $4.1 billion, basically this 5 point something billion dollars. They don't have enough liquid asset to be able to pay that off. Now, having said that, they do have some free cash flow they could potentially use. Okay, but in terms of liquid assets, it would be basically a bit of a struggle. Again, these type of businesses will not run out of cash if they can just borrow a little bit more money. But having said that, there's also the debt levels that we need to see, and the debt levels for this company, last time I checked, I really didn't like it, but there we go. $32.6 billion of basically total debt right now, which is a lot for a company. I can't remember how much let's go back to the revenue. I think it was 20 something, 24 billion in terms of revenue side of it. That's quite a lot of basically debt on their balance sheet. So it'll be interesting to see how moving forward, if they start reducing that debt level, that would be really good. Okay, maybe increase the dividend here and there, basically a little bit, but focus on paying off that debt. And again, some of these companies, they know how to play that game, so they potentially can easily finance them. Okay, levered free cash flow here, we're looking at about 2.7 to right now 4.17. There are different websites that have a slightly higher free cash flow for this company, so which would be interesting. So what we now need to do is look at the company in terms of basically the different types of financials that we normally looking for. Okay, and the first thing we're going to look at is the moat. Okay, so we know the market is market cap is 136 billion market cap right now, wide moat, and basically the beta is slightly lower. Now current PE is 20, the forward PE is about 20, and the 5-year average is 22. So this tells me it might be slightly cheap, basically cheaper than where it has been over the last 5 years. The sector median is about 23.5 right now. This is where the company shines, dividend side of things, 2.38 basically when it comes to the dividend yield. Payout ratio only 48%, and the annual payout basically we're looking at basically $5.36. The 5-year growth rate 11%, which is really good, so double digits, very interesting. Dividend growth rate basically for 17 years. Now safety 88%, so nothing to worry about. This is what I meant, free cash flow, so $5.5 billion. I think this comes from Yahoo Finance. And when it comes to free cash flow, compound annual growth rate, we're looking at about 2%. So not great, but they do have some, of course, free cash flow. Free cash flow margin, we're looking at about 23%, which is very good, way higher than basically what we're normally looking for. Now, gross profit, well, is absolutely fine. Profit margin, we've seen it. Basically, the difference between what the company spends and how much it makes in revenue. So that's about 55% right now. Operating margin of 14%, return on equity of 43%, return on invested capital of 15%. Net income margin for the last 5 years, we're looking at about 27%, which is really good. Almost 10% of total return the last 10 years. So when you look at this, basically you think, okay, this is very good profitable business, which is good. Now this is where the issue starts, and this is why basically maybe they got rid of the new CEO. That revenue now needs to start compounding, that needs to start growing every single year. Okay, at least beating that inflation and so on. EPS growth, we're looking at about 6%, which is not bad, and we've already seen the debt level slightly, the current liabilities being higher than current assets, which means the current basically it's not covered, so for that reason is below 1, and that basically this is what it means. Okay, so the fact that we're looking for above 1 means it can current assets covers the current liabilities, but in this situation it doesn't. Now they're expecting the earnings to grow about 11%, revenue to grow about 4% next year, and of course, you know, we will see where that ends up. Current price, we've seen $225 per share. Fair value, we're looking at $218 from Morningstar. Right now it's basically fair valued, and again it's still, if we see a little drop in the next few weeks, that we can easily hit that $218 per share. According to Simply Wall Street Valuation, 278 is very, very bullish, so about 19% undervalued at the moment. You know, tip rank is saying about 15% upside from where we are right now. It's a moderate buy. 258, 256 from Seeking Alpha, about another 14% upside from where we are is another buy from them. So I'm going to give you the valuation in a second. So as you can see from Sharia compliance side of things, nothing to worry about, and I love the fact that they're buying back their own shares. So you're getting basically less and less, basically more for your money in terms of the shares that you own right now. So because they're buying back their own shares, that means to us, if you own one share of this company, is worth more next year because they're not diluting your shares. They're actually basically buying back some of the shares that are trading outside here. Now, what I'm going to show you now is the next thing, and that is basically valuation side of things. So we've taken all of the things that we've seen now into consideration, and then dividend and discount model that I used to gave me 226, multiples valuation just over $200 per share, average all of that at $236 per share, current stock price 225, so it's around that. It's about 5%. It's basically upside from where we are right now. And if you say, you know what, I need about 10% from basically a margin of safety, which is definitely what I would normally recommend for bigger company, basically companies that are slightly riskier. With this one, 5% should be fine because it's one of those companies you know what is going to happen more or less, unless something crazy happens. There's a crash or something with their one of their trains or whatever it is. There's not much. So right now, $212 per share, I would say would be really good entry. But again, that base 225 or even that 5% basically, which is basically where it is now more or less, I think would be fine. So yeah, 225 and below. For me, I'll show you in a second basically what my average is for this company. But before we do that, I've got one more thing to show you. As always, if you haven't joined us in the Patreon account, please do so, because it takes a lot of time and effort to put these videos together, and paid for all the subscriptions that we use. In this software is actually one of the things that we pay for using this. Now, 5-year total return, we're looking at about 41% for the last 5 years. So that's not great. That's not high growth. But this is foundational stock. We're not expecting to basically outperform the S&P 500 every single year. But I'll show you in 10 years in a second. So 78%, 41%. These basically Canadian Pacific, we're looking at basically right now 50%, 18% for Canadian National Railroads, and then CSV and CS 38%. So it has actually outperformed these two here. This one has done absolutely amazing, basically slightly about 9% higher than that one. Right, 151% when it comes to the last 10 years, 188, so not far off. Of course, I still underperformed the S&P 500, 131, so it's better than this one, 78, but this one has actually done an absolutely amazing job, 219 basically percent total return the last 10 years. So overall, as you can see, it's kind of mid, basically in between, where about 30% or so below basically where the S&P 500 ended up. And again, like I said to you at the beginning, this is not the type of business where you will beat the S&P 500 every single year, so you just have to bear that in mind. And it's a very foundational stock. Like I've always said to you guys, there are some stocks out there that you would buy and hold for quite some time because they're foundational stock, they're paying you that dividend and the growth is there. So let me show you how much I own. So I've owned 26.5 shares. Right now I'm up about 16%, so that is about £679. And as you can see here, my average is actually $205 per share. So I was buying around here, or $159 basically pounds. So what my plan is inshallah, if it comes back down again to maybe 110 or so, I'll probably be buying more, because I would love to get to a minimum of 30 shares of this company. This is for me a long hold, like just basically for or long run, inshallah. It's not one of those companies I'm going to sell in the next whatever weeks. So I hope that gives you a lot of information about the company. Then what I would do if I were you personally, go and find the 10Ks, for example, for this company and go through it. I did that yesterday night, and it's quite actually interesting. A lot of the things that they have, basically what they were talking about in that, it was quite interesting. The fact that they're trying to hire more people that are ethnic minorities. I think they got like a target by 2030, that's like a 40% of their workforce have to be ethnic minorities. One of the issues this company has as well is the labor. So the union, labor unions. So it basically they have to pay a lot more to these basically unions representatives, because it is, of course, that's what you basically Union Pacific, not Union Pacific, UPS, UNCP. UPS is going through that exactly right situation right now, and this is one of the companies that was going through that. So they talked about that. There's a lot they talked about. They talked about basically hiring more female workers and so on, although it's quite difficult to basically hire females for this kind of basically businesses and so on. So there's a lot more information in there that you could potentially learn about the company. So when I was doing the research for us, I had to basically go through all of these things and then kind of give you a summary. So just do your own thing, inshallah. And I did that for myself as well, to see if I'm still interested in holding on this bit to this business. Sorry for making the video slightly longer than I needed it to be, but of course there's a lot more information that I needed to share that with you guys. Anyway, have a wonderful day. Assalamu Alaikum.